Hello everyone, my name is Toon, the Chief Investment Officer of Asia Pacific Equities at RHB Asset Management. Welcome to another episode of our podcast. In the last episode of my podcast in July, we cautioned that unlike the bargain basement valuations that we saw in March and April, we think that the market may now need some time to digest the strong gains made over the last few months. In this podcast, let us try to explore the psyche of the current investment markets. But first, allow me to introduce the concept of Mr. Market. Mr. Market is an imaginary investor devised by Benjamin Graham and introduced in his 1949 book, The Intelligent Investor. Benjamin Graham is widely known as the father of value investing. He wrote two of the most famous books on investing, Security Analysis in 1934 and The Intelligent Investor in 1949. In his book, Mr. Market is a hypothetical investor who is driven by panic, euphoria, and apathy. Mr. Market approaches his investing as a reaction to his mood, rather than through fundamental analysis. Modern interpretations would describe Mr. Market as manic depressive, swinging from bouts of optimism to moods of pessimism. So what if in this modern day and age, we introduce Mr. Market to Tina FOMO? Who is Tina FOMO? Or rather, what is Tina FOMO? The 2020 rally has left some market observers scratching their head, but has also given rise to a bundle of investment jargon attempting to explain recent trends. First, the acronym TINA stands for There is No Alternative. The recent equity market rebound, despite cratering expectations for corporate earnings, has sent stock valuations soaring. For example, the 12-month blended forward price-to-earnings ratio on the S&P index is at the levels we last saw during the tech bubble in 1999. But as of now, investors haven't been put off by the notion of overvalued stocks. Although I would admit that the current super low interest rate environment does provide some justification for higher than historical valuations. But according to one popular line of thought, a key reason for this high valuation in the stock market is because of TINA, or there's no alternative. Bond yields have collapsed as central banks globally slash interest rates and indulge in massive quantitative easing, or QE. As a result, investments in the stock market may have become the default choice. Next, we have FOMO, or fear of missing out. As markets keep climbing, more and more people are being enticed to jump in to join the equity party. Retail investors, especially, have increased their stock market exposures throughout this rally. Some market watchers chalk that up to fear of missing out, or FOMO, as concerns over the COVID-19 pandemic begin to recede, coupled with the heating up of the stock markets. So when Mr. Market meets Tina FOMO in 2020, sparks are certainly flying in the stock markets for now. The massive QE and fiscal stimulus we see globally are obviously adding fuel to the fire. But only time will tell whether this romance will end up as a beautiful love story or a tragic precautionary tale. In the meantime, let me share with everyone a couple of my current thoughts. Firstly, the rally in the stock market could continue on if corporate earnings and economic recovery can continue to support the stock market valuations. But if you look at the economic projections from International Monetary Fund, the whole world is expected to barely exceed its 2019 GDP levels in 2021. And that is mainly driven by China, which has proven to be extremely resilient in this COVID-19 crisis, with continued GDP growth in 2020 and 2021. If we exclude China, the 2021 GDP for emerging economies will be slightly below its 2019 levels. However, for advanced economy, overall 2021 GDP levels is expected to be 4% below its 2019 levels. Even then, IMF admits that there is substantial uncertainty around their forecasts due to the complicated nature of this pandemic. In short, the valuations in the equity market is pricing in quite an optimistic scenario despite this rather bleak and uncertain economic outlook. Next, Federal Reserve Bank President Thomas Barkin likened the US economy as taking the elevator down during the COVID-19 crisis, but needing to take the stairs back up again. I would also add that the stock market took the elevator down in March, but from April onwards, the stock market has since sprinted up the escalator while pumped full of QE steroids. In addition, there's real danger of confusing a rebound with a recovery. A rebound of the economy will naturally happen as the movement restrictions globally are lifted gradually. However, a proper recovery will mean that the economy will need to be as it was pre-COVID, and I think we are still some way off that. The Google mobility data from the US certainly shows a rebound from the lows we saw in March, but we have yet to see strong evidence of a proper recovery to pre-COVID-19 levels. In fact, most countries are at best operating with an 85 to 90% economy, with continued disruptions from social distancing and a lack of a COVID-19 vaccine. Furthermore, over the next few quarters, the market will still need to deal with the fallout of the COVID-19 crisis, which will include higher level of bankruptcies, unemployment, weaker demand, displaced industries, and disrupted supply chains. In conclusion, while we were bullish in late March, as indicated in my earlier podcast in April, the extent of the rally has surprised even us. Cheap money and recovering earnings certainly provide a positive backdrop, very much like when Mr. Market meets Tina FOMO in a QE world. However, as prudent investors, we always like a comfortable margin of safety when we invest, like what we saw in late March. Unfortunately, that margin of safety has been eroded over the course of the last few months. Although all this may not necessarily mean that we are looking at an impending market crash, but we will definitely need to be extra careful and nimble to navigate the markets from now on. With that, we have come to the end of our podcast. Hope everyone stays safe and healthy in your daily lives and in the market as well. Thank you very much for your time.